Hello everyone, I am CA Nemish Gupta and welcome to my channel Making Funds Work. Today we will be covering the taxation on shares, mutual funds and derivatives and the changes related to it post the budget 2024. Let us start. As most of you would know, there have been some bad news for all the investors in the long term as well as short term, since there have been increase in these taxes. However, there is some good news as well in the budget related to mutual funds which you may not be knowing. Hence, we will cover all this in this video. There are three types of taxations that are applicable on the mutual funds in India. First, for the equity shares and the equity oriented mutual funds, that is the mutual funds holding more than 65% allocation to equity shares listed in India. For these type of funds, the taxation was 10% when sold in the long term, that is more than 1 year. However, it has been changed to 12.5% post the changes in this budget. However, there is a silver lining that the exemption in the long-term capital gains has been increased from rupees 1 lakh to rupees 1,25,000 after the budget 2024. When these funds are sold in the short term, that is less than 1 year, then earlier these were taxed at 15%. However, after the budget, the taxation has been increased to 20%. Second type of mutual funds is debt funds. These are the funds where the debt part is more than 65%. In the debt funds, the taxation remains the same and the gains are taxable at the slab rate. The third category are the fund of funds, that includes the gold funds and the foreign fund. Further, the unlisted shares and the hybrid funds which have equity allocation less than 35%. These funds were earlier taxed at different complex rates. However, after the budget, there is a flat taxation of 12.5% if these are held for more than 2 years. However, if they are held for less than 2 years, then they will be taxed as per the slab rate. Please note that the exemption of 1.25 lakh rupees would not be available for these type of funds. Earlier, if the equity part in the hybrid funds was less than 35%, then these were taxed at the slab rate. However, there is one problem that continues in terms of the foreign funds. RBI has imposed a restriction of $7 billion for the overall mutual fund industry in India to invest in foreign mutual funds. This limit is $1 billion per fund house. Hence, many of the fund houses have already stopped investments in the foreign funds. At least lump sum investments are stopped in these funds. Further, there are some fund houses that are still open for investment and are investing money. An article in Money Control captures the details of all these funds, whether they are accepting the deposits or not. I am attaching the link in the description for the benefit of all of you. Now coming on to the next category, that is the hybrid mutual funds that held more than 35% in the equity but less than 65% in Indian listed equity. These type of funds were eligible for indexation and were taxed at flat 20% if held for more than 3 years. However, after the budget, the indexation benefit has gone from these investments and these will be taxed at flat 12.5% if held for more than 2 years. If these are held for less than 2 years, then these will continue to be taxed as per the slab rate. For unlisted shares, private equity investments, the taxation is also the same now and it will be taxed at 12.5% if held for more than 2 years and will be taxed as per your slab rates if the period is less than 2 years. All these changes are applicable if you sold your investments on or after 23rd July. Hence, the date of sale becomes really important to ascertain the correct amount of taxes. Now coming on to the derivatives tradings. The gains from the derivatives will continue to be taxed as per the slab rate. However, the STT which is being paid on the sale of these derivatives has been changed. For options trading, the STT has been increased from 0.0625% to 0.1%. For futures trading, the STT has been increased from 0.0125% to 0.02%. The tax on the futures trade is lesser than the options trade because of the contract size being very high in the futures. All these changes are applicable from 1st October 2024 onwards. This would not have a huge impact on the positional F&O players. However, it may have a very huge impact on the intraday players. Another change is in the buyback of shares. Earlier, the buyback of shares were exempt for tax in the hands of the shareholder. However, after the changes, the buyback income would also be taxed as dividend income and hence it would be taxable at the slab rates. This change is also effective from 1st October 2024 onwards. One small change is if you hold the investments in foreign currency. For example, the employees of companies such as Microsoft, Adobe, etc. may get some ESOPs. Earlier, if they missed to report these shares, there was a penalty of up to rupees 10 lakhs in the Income Tax Act. As per the changes, this penalty would only be levied now in case the value of these shares is more than rupees 20 lakhs. This is a welcome change. Another change in the budget is in the customs duty of gold and silver, which has been changed from 15% to 6%. This has impacted the price of the gold, which has fallen from 73,000 per 10 gram to 68,000 per 10 grams. Hence, if you are planning to buy gold now, this is a good news for you. However, if you hold a large share of golds like me, then it is a bad news for you, as your portfolio value would have fallen. This concludes the video on the topic. In case of any queries, please use the comment section and ask those queries. Thank you.